Welcome to Show, Don't Tell, a podcast by TelScreen's team of Wes Harris and Kent Harris, sharing their stories of being in the eye care industry in their unique, punny style with facilitator Christy. Thank you everyone for tuning in to this episode of Show, Don't Tell. This is part 2 of their financial discussion where Wes Harris and Kent Harris are interviewing our guests today, Tasha Fischer and Michelle Fuchs with Stearns Bank of Stearns Financial Services, Inc., member FDIC, equal housing lender. And they've got more to cover under that whole umbrella of the financial conversation. So let's get right to what that discussion was. Awesome. Well, welcome to this episode of Show, Don't Tell with Kent Harris and Wes Harris. We are so excited to have guests with us today. And look who's sneaking around the corner to wave hi. You can walk on in, Pat, if you want to.
Come on in, Pat.
Come say hi to the gals over there. I'll even hand you my microphone here in a second.
That's all right. Yeah, so wave to Michelle Fuchs. You remember Michelle from many past interactions. And that's Tasha in the bottom box. So on this month's podcast, I'm pleased to introduce Tasha Fischer and Michelle Fuchs from Stearns Bank N.A., member FDIC, and equal housing lender, to cover all my regulatory obligations.
Did you say that with a straight face, though? I'm told you have to be stern when you're introducing Stearns Bank.
I don't think that's a requirement.
Oh, okay. Just checking.
Well, we're pleased to join you guys.
Thanks, Michelle. As you know, this is the prime time for eye care equipment. Doctors get to visit their accountants and find out, gosh, how much money do I have to spend before the end of the year? And a lot of them ask it that way, which I think maybe how much I get to spend, or how much should I spend to minimize my taxes? But no, they say, how much do I have to spend? As if talking to us was more like a chore than a pleasure.
Right.
So with that kind of background, key question is, how does equipment financing work with the Section 179? Is there any difference in their deductions if they pay cash versus finance?
No, really. It all works the same. And just to kind of give you a little history, this legislation was made permanent as part of the tax code, back in 2015, protecting Americans from Tax Hikes Act. It was really nice that it became permanent, because I can remember the days where we're all waiting, like end of November, first part of December, what is that deduction going to be? And so, now we're looking at a robust number of $1,050,000. So it is really generous, the deduction amount. And it's nice because practices know at the beginning of the year what that limit's going to be. And as far as financing goes, pretty much it can be any tangible business equipment. I guess the key thing is that you have it purchased sometime between January 1st and December 31st of that tax year. And that will allow you to take full advantage of the deduction. And of course, too, we don't want to be your tax advisor. So please check with your tax preparer, how that deduction and that benefit is going to fit you, as, everybody's business situation is different. But it doesn't matter if you're paying cash or you're financing, you still get to take advantage of it. So that's the great news.
So I get a tax deduction for equipment that I bought with your money?
You bet. Yes.
That sounds like a pretty good deal.
Right. So yeah, a lot of times people look at it as, depending upon what tax bracket they fall in, but they figure out, take that percentage and basically can almost deduct it from the price of the equipment. And in all reality, that kind of breaks down to what that price of equipment will be for them. So very nice deduction that's available for everybody.
But I can't call it a government coupon, right?
It is kind of like a coupon to buy equipment, right? Yeah. So when it comes to equipment finance, I hear the terms equipment finance agreement and lease agreement, and wonder, is there any guideline on how are these two things different, and how does a doctor know which one to choose?
Sure. No, that's a very good question. And we actually get that often, or, asked quite often. Basically, the terms and conditions are the same. Whether it's like the length of the term, the finance charges, it's monthly payments. We honestly don't see many requests for equipment leasing anymore. I think I hear people use that terminology, equipment leasing, just because it was so prevalent years back when people wanted those deductions that they did an equipment lease, because that way they could write it off as an operating expense. But with the Section 179 being so generous, most people have enough deductions just by taking advantage of Section 179. So really over the years, I've really am seeing more and more people just do equipment finance agreements. So the lease really is not a difference.
So you think maybe a lease would apply more if people have spent $1 million already on equipment and they wanted to do another $1 million, but they wanted to do it all this year, so they might lease the equipment for the second $1 million and then finish the purchase of it a year out, to use Section 179 the following year or something like that, then as maximizing their tax.
Yeah, more in that type of scenario. Would you see that? I guess typically, we're working with small to medium-sized businesses, and so most people are within
the $1 million. They're not bumping their head too much.
Yeah, exactly. So, but otherwise, really, there's not much difference. It's just a matter of who owns the equipment. The lease, the lender owns the equipment, or the lessor, and the equipment finance agreement, the customer owns the equipment from start to finish, and there's no residual, no balloon at the end of the term.
The other question I hear is, isn't it better just to pay cash? I mean, I could write you a check. Why would I, go to a leasing company? And, for our equipment, which, we're mid-20s on down quite often. And so end of the year when cash is accumulated in the practice, a lot of them could just write a check. Is there any reason why they should think about financing instead?
Financing is going to allow you to save your cash for other business expenses or unexpected expenses that come up. Another nice thing about financing is it allows you to generate revenue using the equipment that you purchased, and then you can make smaller payments over time instead of one big lump sum.
So the advantage of having money in the bank for other things rather than spending it all at the end of the year and starting out the next year broke again.
Right, especially with these crazy times we're in.
Okay. I'm sure someone's out there saying, but I want to be broke. It's motivating. Gets me up in the morning.
Right. Go kill that buffalo or whatever. So the other question I sometimes hear, most doctors that are well established in practice don't have to worry about credit scores and things like that. It's pretty automatic for them. But for people starting out, say, a couple years out of school, may still have some student loan debt to clean up, perhaps buying into a practice or cold start. Do doctors in that situation have a chance to get financed, or they just need to suck it up, pay down debt, and wait a few years?
Yeah, absolutely. There are options out there for them. At Stearns, we have a startup program for equipment financing. And with that program, typically, depending upon, how long they're licensed, we may or may not require money down, but we will finance startups. Or another thing they may want to think about is the small business loan. We actually are a preferred small business lender in all 50 states. And so with that preferred lender status, we can really shorten that turnaround time. Granted, you still have to, prepare all the paperwork. We're going to ask for tax returns and personal financial statement and things like that. But we don't have to go to the local SBA chapter to get that approved. So it really speeds up. And, we do this all day long, every day, doing small business loans. So definitely, if someone's looking to open their own practice, we can include everything from the equipment to working capital, inventory, leasehold improvements. We can bundle that all into one loan for them.
So the equipment finance is not the only way you can help them. You also have SBA vehicles available as well that can be more comprehensive.
Yeah. Yes.
Okay. What are some of the questions you guys hear from doctors? I know that they call Stearns and they say, hey, I want to buy a new, hopefully they say TelScreen Diamond system, but whatever they say, what do they ask you about when it comes to financing? What are their concerns?
Well, they ask about what our longest terms are. So we can offer terms anywhere from 2 years out to 5 years, and we do offer delayed payments, pending credit approval. So we can look at 90-day delay payments or up to a 6-month delay in payments.
So the deferred payment thing basically gives them a chance to get the equipment in, learn how to use it with their patient population, bill for it, eventually get paid for it by somebody, either the patient or third party, and then have cash now to pay you back for the equipment finance. Is that the point of the deferred?
Yeah.
And no animals were involved in that process, right? They weren't deferred. Oh. Okay, you can customary groan at this point. I've reached my limit of allowed puns per podcast.
The editor will take the last one out.
Another thing that we get asked is how long is the process going to take? So typically when a customer applies with us, we have a credit decision within a couple of hours. And depending on the urgency of the transaction, we can get the whole thing from approval all the way to funded within 80 minutes or 1 business day. So it just depends.
I know when we're at Vision Expo West and there's somebody walking the show floor, if we have somebody who wants financing, I just text one of you guys and you come over to the booth and take a picture of their driver's license, and it seems like it just kind of happens automatically from that with back-end support of the home office, I guess, and the hidden hamster running on the wheel somewhere. But it's like it's magic, and then you come back in 30 minutes or an hour or two later and say, Dr. So-and-so is approved, and we're getting documents right away. And I've always been impressed by that, being able to do that on the show floor in Las Vegas or wherever we are. That's really a big help to the customers because they can finish everything on the show floor and not have homework when they get back.
Yeah, that's always been awesome. That's always exciting. That brought some of the excitement to the show. When you're a salesperson and you're kind of you're waiting for some customers to stroll by, and then you finally have found people that are interested in your equipment, and to be able to complete everything right there and know that, okay, this wasn't the start of the process, and now you've got to try and get money out of them. So makes it nice to be able to complete everything in one shot.
So we certainly appreciate you guys taking care of our customers for, as I said earlier,
13 years
about
now?
13 years now since we first started. So appreciate that very much.
That's awesome. Well, thank you guys.
Anything else you'd like to add about Stearns before we close? Anything I didn't ask that I should have asked, or any questions doctors don't always ask but maybe should ask?
I'd like to tell you guys how easy it is to apply with us. Our credit application is 1 page. It can be completed online through a secure portal, or we can take the application over the phone. It takes less than 5 minutes. So it's really quick and easy and simple.
All right. Wonderful. Well, Tasha, Michelle, it's always good to see you guys. And we will be going to a few shows next year. Certainly Vision Expo will remain one of our favorites. So look forward to seeing you there at the booth if we don't run into each other before then.
Thanks so much for joining us on our podcast.
Thanks a lot.
Well, those were some really great guests, Wes. Great job meeting people over the years. And they're still willing to talk to us. That's impressive.
So you're saying I have to turn in my engineer card now?
I think so. But get the hair pointed upward a little bit, little pointy hair to thing going on there.
Yeah.
I don't know. The thing that I learned the most from that is that if a doc just asks the question, how much am I good for? They'll give you a pre-approved limit and go shopping. And really can be that easy.
So you take the number your accountant tells you need to spend and the number the bank tells you you're approved for, you take the biggest number and you go?
I think so. Or, yeah, right.
You found the button.
Yeah, we found the button. I appreciate Tabitha and Mindy from Oakmont Capital joining us, and Tasha and Michelle from Stearns Bank, NA, member FDIC, and equal housing lender. Thank you, regulatory requirements. Because, no one would say an unfair housing lender. So who would ever say that? So why do we have to say an equal housing lender? But apparently we do.
Well, in case we have an unequal housing lender out there, then we have to make sure we keep those separate.
Okay. But yeah, the understanding that if you ask about what's the interest rate, you may not be getting the whole story.
Yeah, I thought that was pretty revealing, that make sure you read all the terms of the contract, make sure you understand, is there an upfront payment? Is there a final payment that's different than your monthly payments? And just figuring out how much cash is changing hands. Mm-hmm. Because obviously with some clever accounting, you could get an arbitrary percentage rate just by manipulating the initial payment and final payment.
And the timing of them.
And the timing of them.
Yeah. So if you put together a cash flow list versus time and type it into Excel, you can get the actual rate of return or the actual internal interest rate that you're paying, regardless of what rate was used as the basis for the payment calculation.
But only if you're an engineer.
Or an accountant. It reminds me of one of the worst plans I've ever seen, the so-called baker's dozen. And what you do is you take the amount that you're borrowing, you divide it by 12, and you make 13 of those payments.
Oh, yeah.
So it's a baker's dozen. It's 13 payments formed by dividing the actual amount borrowed by 12. And you think, okay, well, if I'm making one extra payment, that's 1/12. That's about an 8% interest rate. But it's not. Because your first payment is paying mostly interest and very little principal. And when you look at the total amount that's interest versus the amount of principal that was at risk for the lender, their rate of return is closer to 13%, which is, again, a baker's dozen, but not in your favor.
Politician's dozen?
That's
We won't go
another
there.
episode.
So the advice to actually look at the cash flow and figure out how much am I paying, when am I paying it, and then what's the actual interest rate if you called it.
Yeah, if you ask for financing based on what's your interest rate, and that's all you're looking at, well, you better pay attention, because there are some people that have tailored an answer to that question that's maybe a little less transparent.
And not exactly mathematically true. Yeah. So.
Well, awesome. So these have been great guests. You've learned a lot. You picked two great guests to start with on the podcast. So how do we wrap this up? Remember to tell people where to go.
Well, I think the most important aspect actually is what equipment's being bought. And most doctors I don't really consider that. You buy a piece of equipment related to either diagnostics or even therapeutics. But the question is, does that have any effect on your revenue? Is it revenue producing equipment or not? If it's revenue producing equipment, then the issue is, what's the revenue produced versus the monthly payment or the payment? And in some equipment, not all by any means, in fact, most of it doesn't generate as much as the monthly payment. Then the financing and the interest you're paying is very real. On the other hand, if it's equipment that actually generates monthly revenue greater than what your payment is, then it's a net positive cash flow. The doctor's not spending anything out of their own pocket or anything that they've earned by other activities that they do or other patient activities. The equipment itself has paid for itself. And I always like the calculation of return on investment, because you take what the return is and you divide by what you paid for it, cash out of your pocket. And certainly with the financing we heard today, the cash out of your pocket, zero, it looks like that's an infinite rate of return. In other words, there is no better equipment purchase than purchasing equipment that generates revenue, more revenue than your payment, and having 100% financing. And quite frankly, in that situation, it kind of is a little bit immaterial what the actual, quotes, interest rate is, because you made money off the equipment. That's the part I think that often doesn't get considered or heard in making a decision about what's good for the practice financially as well as what's good for my patients.
Well, I'm so glad he jumped in there.
So equipment that earns more money for the practice obviously is the best. And then the second best would be equipment that makes your practice more efficient. You find a way to save money, save time, allow you to see an extra patient per day because you're faster with this equipment than you are without it. So equipment that produces revenue is certainly the best. Equipment that saves you money, makes you more efficient is next. Equipment that you don't feel like you could just live without, even though it maybe doesn't add revenue or make you more efficient, but it's just cool to have. That would maybe be third best and should be further down on your list of things to purchase.
Certainly want to know what the interest rate is.
Absolutely.
But I think Christy was really looking for where do you find this information and more. It's www.TelScreen.com. Is that what you're looking for?
Wait. Yay.
And you can find us on Spotify or your favorite source for podcasts.
Absolutely. Thank you for listening.
Thank you for listening. Yes, Mom.
Thank you for tuning in to Show Don't Tell. I have been your facilitator, Christy, and you've been listening to Wes Harris and Kent Harris, the engineer minds of TelScreen, creators of the newly released Diamond iRes digital imaging systems. Did you like this episode? Leave us a great review and follow us on Facebook, Spotify, Apple, or find us on your favorite podcasting channels. The easy way is to simply visit TelScreen.com. That's TelScreen, TelScreen.com for all the latest episodes under the blog tab. And thanks again for listening to this episode.